Hi, everyone, and welcome to another Dolphin Financial Radio Show. I'm Dan Wendell, the host of today's show, and today we're going to be talking about dollar cost ravaging. You've heard of dollar cost averaging. Today we're talking about dollar cost ravaging. I've talked about this before, sequence risk. I've done videos on this. I'll put one up here. If you haven't seen the sequence risk video, watch that. But we're going to talk about it in detail today. To help me talk about dollar cost ravaging, I'm going to bring in Tony Shore. There he is, Tony Shore. Wow.
Nothing but noise, baby.
Very, very loud sound effects. I love it.
I know. I had them turned up a little bit there because people were excited to see us today. But Dan, thanks for having me on the show. Yes, I am here, and I've had a good week. How about you? What's going on over there? I see some graphs and charts behind you.
Yeah.
That's not going to do our podcast listeners any good, but our YouTube viewers might enjoy that.
Yeah, right. I feel like I got the little devil and the angel on one shoulder. We got the market going down on one shoulder, market going up on the other.
Yeah,
we're going to be talking about the stock market, in particular, talking about investments and how. Well, you know what we could call this show instead of dollar cost ravaging, which I mentioned it in our last show, dollar cost ravaging.
I like that.
We've done a show on dollar cost averaging. Remember,
Yes.
we did a show on it, and the question I had for you was, is it better to dollar cost average, meaning invest a little bit over time, or is it better to throw it all as a lump sum right off the bat?
And I said it's better to do a little bit over time, and you then proceeded to tell me why it might not be.
Right. Watch that show if you want to know the answer. Spoiler alert, Tony was wrong. So this show, it's not much of a spoiler alert. It's understood now. This show, I might want to call How to Run Out of Money in Retirement. Because that is the bigger fear. That is the number one fear people have, is I'm going to run out of money in retirement. Right. So I'm going to show people how they can run out of money in retirement in the hopes that they don't. And we're going to talk about, because right now people are saying,
if you know how it happens, you can avoid it, is what you're saying.
Right. That's right.
Okay.
People are aware of dollar cost averaging.
Sure.
Putting a little bit of money into your investments over time. So a 401k, people are dollar cost averaging.
Mm-hmm.
What we're going to talk about now is actually taking money out of your accounts because you're retired. And it has a negative effect, or it could have a negative effect, if you have some returns in your investments that aren't aligned with your end goal, which is to not run out of money. So we're going to show you how you could. So the question becomes, Tony.
Yes.
When it comes to dollar cost ravaging or sequence risk, and sequence risk is the term we always like to use because it's more specific. Sequence risk, and what that means is, does the order of returns or the sequence of your returns matter? Does the sequence or the order of the returns you get on your investment matter?
So I've always heard yes, that it definitely matters.
It doesn't.
You go against conventional wisdom, Dan, every time. That's why I just said I had heard.
Yeah,
that's what I've heard.
Is that your final answer?
No, I'm not saying that. I'm just saying that's what I've heard.
Well, it does matter, but it doesn't. It depends. It depends if you're retired or not.
But
so, all right.
But can we back up before you launch into this and tell people, obviously, I think people out there want to hear about the markets because they're concerned because they've been so volatile. Yesterday, they went way back up for a little bit, and then I noticed at the end of the day, they were going down. But if you look at 2022, this year so far, it hasn't been good, right?
No,
the war in Ukraine and coming, COVID and inflation, the markets, these things and other things have caused the market to go up and down. And I think if we're going to talk about the market, we got to have a lead in.
Right. The markets are open as we speak, and who knows what they're doing, Tony?
Yeah.
but they are volatile lately. Are you?
Yeah.
I'm gonna start calling you Dr. Doom. Jeez.
Oh,
Why don't you Debbie
well,
Downer over here? No,
well,
you're
that's
right.
why I'm just giving you have to have the pain point to understand why you need the solutions, which is what you're bringing us as some possible solutions for people out there who are worried about this.
That's right. And for a lot of people that are worried about it, what is the usual answer that financial people, professionals give when it comes to stock market volatility?
Just stay
What's
the course.
yes, just stay the course, don't worry about it. But when you're close to retirement or in retirement, you can't go on that general guidance. Let
No,
me
then you
let me
actually need to do something.
right. So this is when the order of returns actually matter. So let's imagine, Tony,
Okay.
you start with $100,000.
Okay.
Okay. And we're going to keep it simple. We're going to only go 3 years. And I'm going to tell you what your returns are each year. And I want you to kind of give me a feel for what you think is happening here. So you start with 100,000. The first year you make 20%. Aha. The second
Oh,
year
that's a
you
really
make
good year.
you make another 20% the second year. All right?
Awesome.
Woo! And
Mhm.
then the last year you lose 20%. Are you up or down over that time? Over that 3-year period, are you up or down?
You're up 20%, right?
See, that's the conventional thought is, all right, I gain 20, I gain another 20, so now I'm up 40, and then I lose 20, so now I'm up 20. But that's not how it works because math. Okay. What happens
I was
is
told there would be no math. I'm glad you're doing the math. That's why you're here.
after after 3 years, 20 first gain year, 20 the second year, and then a loss of 20, you're at 115,200. Okay. I want to show you how that looks. I'm going to
Hmm,
share my screen. And for the
interesting.
listeners, you're going to be like, well, what is this guy doing here? I'm not.
Are you saying I actually should have paid attention in math, algebra, and calculus?
Seriously, you should
Because
have.
news alert. Yeah.
So, Tony,
Come on.
20% up, 20% up, 20% down. The average return is 6.67%. Not bad, right? Can you see my
Mhm.
screen?
Yep, I can
So,
see it.
hey, Tony, next 3 years, I'm going to give you 6.67% on average per year. You'll take that, right? You'll take that.
Yeah, I'd take that.
And if you look at the first section, that's the one I told you. First
Although
year,
that's just keeping up with inflation at this point.
it's transitory, Tony.
Yeah, okay. Yeah, that's what they say. Inflation's just transitory. It's not gonna stay.
Well, I do think that it's going to drop down. It's not going to be 7% in perpetuity. That would be ridiculous. But then again, we could be in Venezuela. So, okay. So 20% up the first year, 20% up the second year. So now your
Hmm.
100,000 is at 144,000. And then you
Wow.
lose 20% of 144, which is a bigger number. That's how we get to 115,000. Now,
Ah, I
let's
get it. Sure.
change
I
let's
wasn't
change the
thinking of the
order of
percentages.
returns.
Yeah.
Right, the percentages. If it's, "Hey, I'll give you 20 bucks, 20 bucks, and then I take 20," then, yeah, now you're up 20 bucks. But when it comes to percentages, you gotta remember, when you lose 20%, you're losing it on a bigger number. So that's
So
what it is.
it's a bigger amount. Yeah.
Right.
I
Now
yeah,
let's
I should have
let's
gotten that.
change the order of returns. So let's make 20% the first year, lose 20%, and then gain 20%. You'll see we end up with the same number, 115,200. But we took the scenic route. We gained 100, we're at 120. Then the second year we were at 96. So now we started with 100, we gained 20, we lose 20, and we're down. How is that possible? Because again, you lose 20% on a bigger number, you're going to lose a lot more than
Yeah.
20,000. You
Yeah.
lose 24,000. So
Mhm.
that's how it happens, right? And then that last scenario, we lose 20 that first year. Now we're down to 80,000 off the bat. We gain 20 the next year. We're only at 96. And then we gain another 20. We're at 115. So what's the difference here? Nothing.
Hmm.
After 3 years, they all have the same exact average return because they're the same three numbers in a different order. And if we don't touch the money, it doesn't matter,
Hmm.
right? If you don't touch your money, the orders, the order in which the returns happen don't matter. You're going to gain 6.67% on average. Who cares?
But
Don't
what
touch
if you're taking money out during this time because you're in retirement and you're using it for, people have their money in the markets in retirement, and they have to have that money to live on. So let's say each year they take 4% out.
See, now this is where the show turns. Now we need the
Mhm.
creepy music.
Oh, the creepy
You-
music. I don't know
what
if we have
happens?
creepy music.
What happens when you start withdrawing from a portfolio? Like you asked, it's as if you knew what we were going to talk about, Tony. And the good news is, there you go. Everyone knows that you had no idea what we were talking about. No one's fooled. But you led right into it. What happens when you start withdrawing from the portfolio? Does retirement income
I know what I'm talking about. Come
does retirement
on.
income change anything? So now, Tony, it's like, okay, we're going to start with the same scenario, 100,000, and we're going to have those same order of returns, but all of a sudden now we're living off of this. We're going to start taking money out. So you said 4%, I'm going to say 3%, just to go against you. All right, so we're going to take 3% of the money out. And then we're going to increase that by inflation of 3%. So here's what we're going to do. Same scenario. You start with 100,000. You get the same returns, 20% or up or down each year. And you're going to start that first year by taking out 3,000, 3%. And you're going to increase that 3,000 by 3% every year. So 3,030 and so forth.
Yeah.
So
Makes
what do
sense.
you think that's going to do? Does the order of returns matter now?
Yes. I will say yes.
Ding, ding, ding. You're right, Tony. Let me share my screen again because this is going to really, and I'm keeping it very simple. We're doing 3 years now. A lot of people, they are retired for a lot longer than 3 years, and 3 years is just I don't know, a simple way of going through it. So you see my screen, Tony? There's
Yep.
the doesn't matter what happens if you don't touch the money. Let's scroll. Aha. So here again, 100,000 on each scenario, but we're withdrawing 3%. So this shows you the withdrawals each year. 3,000 the first year, $3,090 the second year, and 3,183 the third year. So you're taking money out no matter what because you need those new records every year. You got to go get your new fancy LPs at the record store. And I don't care what the stock market does. I don't care what happens in Ukraine. I'm buying my records, right? So that's Tony's model. This is Tony's life, right? But here's what happens. Look at the 3 different scenarios. In scenario 1, we're up after 3 years, 106,000. Wait, I thought we were up 115. How can we only be up 106? Because you're taking out over 9 grand, right? So
Yep.
that's the problem, right? So we're at 106, 104, and 103. 3 different scenarios. How can you have 3 different end results if you're getting the same exact average return of 6.67%? You're taking the same amount out. Why is there different returns here? Why we have different end results after 3 years? And the answer is the order in which the returns happen. Notice, Tony, the 1 year, the one scenario that does the best after 3 years having 106,231, that's when you lost 20% in the final year. The year you lost 20% in the scenario you lost 20% in the second year, you're at 105 basically. And the scenario where you lose 20% right out of the gate, that's your worst scenario because you're down 103, down to 103 after 3 years. So what is going on here?
So the sequence of returns makes a difference there.
Makes a huge difference. And the reason why is because if you see in that scenario, the third scenario where you lose 20% in that first year, instead of being down 100 down to 80,000, you're down to 77,600 because you took 3,000 off right off the bat. And then you lost 20%. So now instead of being at 80, you're at 77. You have to overcome that. You have to start. So you make 20% the next year. You're not starting at 100. You're starting at 77,000. So yes, you're making a good return, but it's on less money.
20% of 77,000 is a lot less than 20% of 100,000, obviously.
Right. And in the other 2 scenarios, after 1 year, you're at 116,000 and you're getting 20% on top of that. So this is why you see having good years in the beginning is really helpful. having negative years in the beginning is very harmful. And this is just 3 years.
But
This is
some
just 3
people,
years.
right, but and if you're in retirement for 20 years, imagine what could happen. So, but Dan, a lot of people are saying, "Well, what difference does it what how does it help me to know this?" My question is, how does it help us to know this? Because we can't predict the sequence of returns or control the sequence of returns, can we?
No, you cannot. But you can control how how you are impacted by them by controlling your investment portfolio. Most people get this concept. All right, if I don't touch it, everything's fine, because that's what they're told their whole life.
Yep.
Don't think about it. Don't look at your 401k statement. Just keep
Yeah.
your eyes closed and keep
Yep.
investing, keep saving, right?
Mhm.
But when you get closer to retirement or in retirement and you start living off of it, you have to change your mentality, because the mentality of don't look, it'll all come back doesn't work when you're taking money out. The order of returns does matter. So what is the number one thing you got to do is you have to change your mindset, and you have to change your portfolio to reflect the need for income. Because if you do what you've always done, which is I'm going to invest in stocks, I'm not going to think about it, and I'll be fine, you could run out of money if we have terrible years in the beginning. Case in point, I retire in 2006. I love life. I have enough in my portfolio. I've put my blinders on my whole life, and I'm not worried, and I continue to save. I have $1 million in 2006, and now I'm drawing 50,000 off of it a year. I'm happy. 2007 comes, I'm still happy. 2008 comes, time out, this, what is this, black swan event? What is this? Real estate, 2009, we're still down. What's going on? Now I'm scared, because my $1 million is now 700,000. Wait a sec, Tony. No, this is not acceptable. I still need my $50,000. I'm not changing. My expenses didn't go down. My portfolio went down. That's a prime example of someone that retired at the wrong time. My thought, though, is, Tony, you don't retire at the wrong time. You retired at the right time. You just had your investments in the wrong portfolio mix. So the key is, if you're going to retire and start withdrawing money, you have to make sure that your portfolio is not subject to sequence of returns risk. The way to do that is to build a retirement portfolio that is aligned with the risk profile, but also when you're pulling money out, you're not pulling it from an asset that's going to go down due to a market fluctuation.
Yeah, so what you're talking about is asset allocation. It's where your money is at. And that's how you protect against this. So if you know your monthly expenses that you need to live on in retirement are going to be about X, and you can find that number by working with a financial services professional like yourself. That's how you figure all this out, and even account for inflation and healthcare costs. But once you have that number and you're working with a financial services professional, what you need is, okay, I know I can use money from Social Security and not affect my returns and not deplete deplete my funds. And then I know there can be other options. There's a lot of retirement vehicles out there that you can be in, and maybe some different portfolios within the market that are less subject to higher ups and downs. You can even
That's
get a
right.
buffered index or something like that. So there are options, right?
That's right. So let's imagine the scenario again where you have 100,000, Tony, and you said I need 3,000 a year plus inflation for records.
Yeah.
Okay? So instead of taking your 100,000 and investing in the market, let's take 90,000 and invest it in the market. This is a very
Yep.
simple example. Take 10,000, because you know you're going to spend that over the next 3 years on records.
Yep.
That's a different, that we seek counseling for that, but we're going to do it.
I do
We're going
need
to
counseling for that.
this is a fairy tale. So
Yeah.
we're going to, enable you here. We
Sure.
take $10,000 and we throw it in the bank, making nothing. Or we throw it
Okay.
in a CD making 1%, right?
Sure.
Fine. You know that money's there.
Mm-hmm.
So what happens when the market goes up 20% on your 90,000? Are you going to do anything? No. What happens when it goes down 20%? You can do anything? No, because
No.
you got your money for your LPs in your pocket at the bank doing nothing. And you
And so
don't
that
have
is
to.
where staying the course comes in.
Exactly. So we're not sequence risk, and this idea is a lot of people that talk about sequence risk or order of return risk or dollar cost
Mhm.
ravaging, they fearmonger a little bit. They say, "Oh, you don't need any risk. You got to stay away from the stock market. Pull it all out, put it under the pillow, or buy this product and put it all in safety." That's the wrong way of doing it, because you got years that you need the returns. And where do you get the returns? In the market. So you have to stagger or ladder or bucket or whatever you want to call it. You have to make sure your income that you're going to need isn't going to impact your returns. So you need to make sure that you strategize on your income need and your investment need. You do not pull out of the market because, again, all right, let's imagine that. Let's say, all right, Tony, right now, 2022, you have all your money in the market. The market crashes because of who knows why. Ukraine,
Yeah.
uh, reserves going up, rate going up, inflation, right? Oh, market tanks. You're like, I'm done with this. I'm going to pull all my money out and I'm going to park it in cash and I'm going to wait it out. When the market comes back up, you're sitting on the sideline still saying, I told you the market's going to come back. And then 6 years later, you're saying, oh man, I really missed it. So you can't just go on the sideline. Retirees need risk. We've done a show on that, how
Yeah.
retirees actually increase their risk as they get older. It's counterintuitive. But the whole point is sequence risk or dollar cost ravaging is not about not spending money or not investing in the market. It's all about changing the way people invest when they retire. Instead of accumulating wealth and growing and doubling, tripling their money, now the focus is on how do I spend my money without running out.
Right.
Totally different mindset. And that's the number one lesson here. You have to change your mindset.
Yeah. I would agree with that. That's a great lesson. And I like the way you explained it. It's very understandable. You broke it down really well. And I think that our listeners out there need to be working with somebody like yourself, a financial, whether it's you or someone else, they need a financial services professional who they can trust that can go over this with them and get that plan in place. Otherwise, especially if they're within 5 years of retirement or in retirement already, got to have that plan in place.
Right. And so when you're dealing with someone and creating a retirement income plan, the things you need to be aware of is the order of returns matter if you're pulling money out, which most retirees are. They're living off of their income. The investment returns make a big difference, particularly early on.
Mhm.
If you do well, if you hit a home run, if you retired just as, right as Donald Trump became president and the market raged, remember that like crazy 100% return. If you retired at that point, you're sitting there like, wow, I had everything in the market. I'd be foolish not to do that. You're lucky, right? You got lucky.
Yeah.
And so you got to eliminate that risk by talking to your advisor and say, hey, yeah, you're showing me an 8% return. I'm not going to sit here and debate whether or not that's too high, but whatever. You're showing me an 8% return, but what if I lose 8% in the first 3 years? Well, that it's never happened. We don't lose 8%, on average. We're going to No. What if we lose 20% for the first 2 years in a row? What does that do to this pretty plan? And if the answer is, well, that rarely happens, that's not a plan,
Well,
you know?
and it does happen. And I mean, we're seeing it. I mean, what if you retired in December or January?
Of
What if you
2022,
retired
right.
January 1st, 2022,
Right.
and you
And the
started
market's
pulling
down 15%.
and you had all your money in high risk in the market, in high
Right.
risk stocks, or at risk in the market, and you started pulling out, oh, okay, I need $10,000 this month. Boom.
Right. You're pulling out at the bottom, and
Yeah.
we know that's a bad deal. Are you going to panic? Are you sitting here saying, "Oh, that's exactly what I did, and now I'm a little concerned"? It might be too late at that point. And
Yeah.
I'm not scaring you. I'm just saying, like, you might have no choice but to ride this out. And so, what do most people do? When I say people run out of money in retirement, that's their big fear. I rarely run into anyone. I don't think I've run into anyone that's run out of money, and not just because I'm overseeing them. I deal with people that I don't help. They don't
Mhm.
run out of money. What happens is their lifestyle changes drastically. They just spend less. They deal with it, right?
Because they have to.
They have no
Or
choice,
or
right?
they'd have $0. So,
So
yeah.
people don't run out of money. What they do is they live a life that they don't want to live. And so that's the
Mhm.
way it should be. I don't want to have to reduce my lifestyle because
Right.
of the market. Like, that's no way to retire.
Yeah.
You're better off coming up with a number that works in all market conditions and being comfortable with that. That's
Yeah.
the way I operate. So it's a very specific concept. Dollar cost ravaging or sequence risk is very specific to retirees because those are the people living off of their income, their
Yeah.
assets.
Yeah.
Those that are younger, like you and I, that are not retired, that are still working, we don't really have to think about this. And that's why it's always something, it's always new to people. So what I'm trying to get people to be aware of is, as you get closer to retirement, start thinking about this, because you should adjust your portfolio to reflect an income need, which can ravage your portfolio.
And if the financial planner or person you're working with isn't talking to you about this in the same way, then they're not doing you justice. They're not looking out for your best interest, because it is a real thing. And if somebody actually said, "Well, this doesn't that rarely happens," it's like, okay, what about the millions of people in our country who retired this year? I mean,
Right.
because there's hundreds of thousands of retirees out there, even in
Right.
the millions. The baby boomers retiring at a huge rate. So a lot of them retired end of 2021, beginning of 2022. What about them? Because it happened to them. If they're taking that money out of stocks, uh,
Right.
they're suffering the, you know, dollar
They
cost ravaging
they could be in a situation where they're saying,
sequence of
I might have to
return.
go back to work. I might
Yeah.
have to, due to no fault of their own, except they kept the money invested in in a situation or portfolio that wasn't aligned with what their income need was.
Boom.
That's it. So that's
That's the
that's their
punchline
fault.
right there.
That's their fault in a way, you know.
Yeah.
Granted, no, who was going to know that COVID was going to happen in 2020?
Yeah.
Who knew?
Who
And the
knew
market
Russia was
10,
gonna attack
35%.
Ukraine and it would cause this big stink and an oil
Right.
crisis, and yeah,
Right. So
but these
no
things
one
happen.
knows.
The
No
black
one
swan
knows.
events happen, and it
Right.
seems like they've been happening more frequently, so
Right. Right.
I think it's
Exactly.
more important than ever to hedge against that, right?
Exactly. There's no more excuses here. Everyone
No.
knows that these things happen.
Yeah.
Don't fall victim to it. Don't play the victim. Be proactive and build a retirement income portfolio that allows for this to happen, or in fact is designed for these things to happen. That's
Right.
the only way I could see doing it. So
Yeah.
there we go, Tony. Thanks for playing along. Thanks for doing some math today. I know I'm pushing the limits
You
here when I
actually
make
made
you.
the old I had to use the old
I
brain
did.
pan a
Was
little
that?
bit in the show.
Your
Did you see the
headphones
smoke?
melted? Yeah, I
Did you
saw
see the
something.
smoke?
Yeah, there's
Yeah.
definitely.
Yeah.
Wow. Wow. Yeah, that was some smoke coming out of their head there. The little hamster in there is like, help me, help me. All right. Tony, enjoy the rest of the day. Thanks everyone for a good show, and don't fall victim to dollar cost ravaging.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Whittle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.